Hey everybody, Kyle Knott, your average finance guy. Wanted to touch base with everybody here again on a example of a velocity banking and kind of breaks through everything. It's a good example, kind of goes through all the steps. Hopefully everyone can follow along. This is kind of the same number, same play of a different video I did, but hopefully I'm getting better at this stuff. And we can help you guys out. So I got a stupid graphic here to start things off, but let's get into it. Velocity banking, a strategy for debt reduction and wealth building. Let's do this. All right, come on. Okay, velocity banking, you guys can read, right? So I'm going to show you the concept. I'm going to help you figure out what to pay off and how much wealth do you actually want to build. Hopefully a lot. Here's the numbers. Know your numbers. This is the hardest part of the whole thing, okay? Knowing your numbers is, I ask people, and okay, well, I got this. This is my mortgage payment. It's like, well, what's everything else? A mortgage payment's fine. I'm glad you want to pay your mortgage off, but we have to know all of the numbers to get through everything. So that's where this sheet is at here. You can get this on my website. I'll try to figure out how to put a link in the show notes or comments or whatever. Not that technical savvy yet, but I'm working on it. So this person here, we had a monthly income of $71.93, and they had this sheet, but they did not fill all of these out or share them with me or want to, and that's fine. I don't really care what these are, but this is just a way to help you to figure out what your final numbers are. So whatever these were, I added up. They said that their expenses are $6,542. Okay, and then with that, this is all their debts. So they had looks like they maybe don't have a mortgage or don't want to pay it off or what. I'm not real sure. But they got 2 car loans, and we got 1, 2, 3, 4 other debts here. Looks like we got probably some credit card debts, and then a 9%. Maybe that's a personal loan or something right there. So you can manipulate. You can call these whatever you want. This is just kind of a generic sheet that you use to go through and figure everything out. Just make sure we know the balance owed and the interest rate. That can help you figure out kind of what you want to knock off first and second. All right, so jumping into it here, debt breakdown. Okay, we got a car payment is $330 a month with at 3%. We still have 12 grand on it. Car payment number 2, $488. This is only 2%, real good rate. They don't owe much on it. Credit card 1, 2, 3. Okay, and personal loan here. So here's our monthly payments of $250, $50, $60, and $640. And our interest rates, we obviously want to knock these things out as even the 9%. Let's get these knocked out as quick as possible. The 2 and the 3, maybe not so much, but let's see where we're at. Looks like we got a home equity line of credit available of $27,000 at 10% interest only and a 10-year draw period. Remember, we want at least a 5-year draw period on that. These people got a 10. It's at 10% interest, not the greatest, but hey, it's better than 19, 18, and 23. A little bit worse than 9, but whatever. We'll knock it out too. All right, so total debt payments right now is $1,423. Again, from our last sheet, monthly income, we got monthly expenses of $5,119 plus $1,423 in debt payments for a total now of $6,542. Cash flow is our income, which is $71.93 minus all of our expenses. So right now we've got $651 a month in positive cash flow. At least it's positive, all right? A lot of people these days are negative, but it still doesn't matter. We can still work with a slight negative, but if it's positive, it's all good. And I'll show you why. So here's what we're gonna do. We got a $27,000 home equity line of credit available, so we are going to go through here, and we got enough room to knock out 14, 67, 51, 27, 29, 75, 22, 95, and 7206. All right. So added all those up, that's $19,000 in debt transferred from the credit card to the home equity line of credit, freeing up $1,093 of extra cash flow. Why is that? Well, because you no longer have to pay the $48 a month, the $250 a month, 50, 65, 240. Add all those up, that equals $1,093. Now yes, we paid these loans off, but we transferred them to a different type of loan, right? A home equity line of credit. So we still owe these loans, so let's keep on doing what we've always been doing. Let's keep on making these payments, which is $1,093, right? So increasing was cash flow. Okay, so that now the cash flow goes up to Okay, resulting interest only payment. Okay, so as we use $19,000, all this stuff added up is $19,000. Now on that loan, we have to pay interest only. So we'd still have to pay on that, just because we moved it over, but the interest on that is $159. So we got $1093 in monthly payments, the 48, 250, 50, 65, and 240. Again, all those was just reduced to $159. Okay. Excuse me, but we are not done yet. We're just getting fired up. All right. You just transferred a lot of debt. All right. Don't go get up again. This is where the behavior comes in. Okay. Too many people go and say, oh, look at me. I don't have to pay. I came up with $1,000. I have an extra $1,000 a month, and they go right back out and they blow it, and they dig the hole even deeper. If you guys are serious about this, don't even try velocity banking, because it's not. If you don't have the mindset to do this, this is only going to make things worse. Okay, so this is where the behavior comes in. Right now, you got to be committed to this, and this will change your life, I promise. But don't go get up, please. Okay, next slide. I'm done preaching. The numbers, here we go. Velocity banking, the balance of our home equity line of credit is $19,070. Our expenses each month, we knock those down to $5,449. Our debt payments, $330. Remember, we still had the $330 left of the one payment, or the one loan that we did not completely eliminate. We've got our income and our $1,744 in cash flow. Okay, now you take your entire paycheck and deposit that into your HELOC. All right, you get a paycheck. I get paid on Wednesdays. I get direct deposited into my checking account. I take that, and I got online banking. And as soon as it shows up Wednesday morning, I make the transfer, and I put the whole thing right into my credit card. Or sorry, not my credit card, into my home equity line of credit. All right, and then I pay all expenses with check writing abilities from my home equity line of credit. So my car payment comes out of my home equity line of credit. My credit card bill comes right out of my home equity line of credit. I cannot take my, for some reason, I don't know why, but my, like I said, it's one of my card payments will not come out of there. I got to take that out of my checking, but all I do is I leave a little bit into the checking, and then I transfer the rest into the home equity line of credit, try to knock that down as fast as I can. So this is basically replacing your checking account. All right. Month one, our home equity line of credit balance, like we said, was up to $19,000 minus our income. We add back into our expenses. So say this is, you get one check. I don't know how many paychecks they get, but say you get half of that goes in on the first, and then you got, a couple thousand of expenses come out. You got fuel in your car, whatever it is, comes back out throughout the month. The total adds up to $5,449. And then plus you got to add that home equity line of credit interest back in on top of that. So at the end of all that, this is like another bill. You've taken your HELOC balance from $19,070 down to $17,485. Month two, you take this balance right up here. From there, you're going to subtract your income, because you're putting your entire paycheck right into your home equity line of credit. What that does is it knocks your balance down as soon as that money comes in, because you pay interest on how much money you owe, and it goes on an average daily balance. Okay, so when I actually take these numbers, these are the most conservative numbers that you can find, because that's the way I like to run all my numbers. I'd rather be pleasantly surprised rather than trying to sell you guys, and I'm not selling anything, but show you guys how great this is, and then, when you actually do it, it's worse. Opposite. I'm showing you how great this is, and it's actually better than these numbers that I'm showing you. Okay, so income goes in, expenses go out. HELOC interest is now from $159 down to $146, because we owe less, we pay less, right? So HELOC balance is down to $15,800. That goes up for month three, $15,800 minus your income plus your expenses plus your HELOC interest gives you a HELOC balance of $14,275. That comes up to month four, same thing. Your original balance is now $14,275 minus your income plus your expenses plus your interest. We're down to $12,650, and we're only 4 months into it. All right, let's Keep going here. All right, month 5, you guys get the hang of this. We're 12,650 minus 71 plus 54.49 plus 105 interest. We're at 11,011. All right, 11,011 goes up, comes down after that month to 93.59, down to 76.93. Month 8, we're down to $6,013 after 8 months. All right. So our HELOC balance is down to $6,000. Now we can take that last car and we can pay that off. You might want to, you might not, whatever, but let's just knock it out. Let's get this $330 back and let's keep on cranking here, okay? So the HELOC balance is now you had the old balance of $6,000. We're adding $12,500. Now remember too that what month are we in? We're like 9 months into this already. Yeah, 8th, 9th month. I didn't change this at all. Okay, after paying on that for 9 months, you're going to knock the balance of it down. I didn't go through all the calculations to figure out what that would have been. It's going to be less than that. Obviously, we're paying a little bit towards the principal every time you make a payment on that. But I'm just, again, being conservative, taking the worst case numbers, and we're just say that we didn't pay that down at all, which it's only a 3% rate, so it would have went way down. But anyway, I digress. We're back up to adding that old balance of $6,000. We're going to add the $12,500 to it. Comes up to $8,538, but no more payment of $330. So that $330 that we were making for the car payment now goes back into our cash flow and goes back into paying off our HELOC. Okay, so that drops expenses by $330. So it goes from $54.49 minus $330 down to $51.19 is our new expenses. So that means, as Velocity Banking says, everything just goes with velocity, goes faster, right? Month 9, $18,538 minus our income. I'm saying our income stays the same. If you get a raise during this time or any kind of bonus or anything, you can throw that in here and accelerate this even further. Again, staying conservative here. Expenses, $51.19 plus your HELOC interest is now back up to $154 because we have a bigger balance on it, right? So now the balance is $16,600. 16,600 goes down to 14,600. 14,600 down to 12,700. 12,700 1 year later is down to $10,762. 13, we're down to 8,700, down to 6,700. 6,700 down to 4,700. 4,700 down to 2,700. We're almost there. Month 17, 27, 25, we're down to $674. $674, if you subtract and put your entire income in there, guess what? You don't have to put it in your HELOC anymore because you got everything paid off. All right? So that'll take your HELOC balance to zero, and now you've got $1,394 in cash left over. All right? Less than 18 months to pay off $31,595 of debt. You now have a positive cash flow of $2,074 each month. And when we started this a year and a half ago, you had $651 extra to spend. Could you imagine a year and a half later from right now, you have no debt and you have an extra $2,000 in your pocket? What would that feel like? Please don't go back and rack the debt up. Live your life. Let's do better. All right. So to list this out, Velocity Banking, the steps, you have to create your budget. You got to know your numbers. That spreadsheet that I had back in the earlier in the presentation, go ahead and find that. Grab that off the website, fill that out. That's the most important part. List all your debts. Open your home equity line of credit. I've got a whole video on just how to do that. Please find that in my library, and that'll show you everything you need to know about a home equity line of credit. Smash that debt. Become your own bank. Take over the banking functions all on your own. All right. Why does this work? So interest, when you get a mortgage or a car loan or any kind of amortized loan, the red here is interest. The bank takes all their interest way up front. Okay? Take this, this is just an example of a $400,000 house with a 20% down payment and a $320,000 loan. This is only at 5% for 30 years. The payment of $1,717 We're saying we're starting this on January 1st, and total interest that you're going to pay on this is almost $300,000. You bought it for 320, okay? Or I guess you bought it for 400. You got a loan for 320. You're paying almost that in interest. All right, back to the bank. And they're getting it all right up front. They know that you're probably going to move in 5 to 7 years, or in 5 to 7 years, the value of your house is going to go up, and then you are going to go and refinance and give it and start it all back over. You're going to start it back on a 30-year clock, which means that's the highest that the interest will ever be, is that first payment is the most interest that you ever pay, and it just keeps clicking its way down after that. So the bank wants everything you do. Imagine if you've had a loan for 5 to 7 years. I've got one right now, and I get emails constantly. You know how much equity you have. You could lower your payment. You could do this. You could do that. The bank just wants you to reset that clock and start you paying interest again. Don't do it. All right. Budget you must. Okay, you got to know your numbers. All right. This is not for everyone. I'll be very upfront back in the slide where I told you not to F it up. This is not for everyone. You have to know yourself. If you know that you don't have the capability of paying off a credit card and you're just going to go rack it right back up, don't do it. Just keep doing what you're doing, whatever that is. I don't know why you would, but keep being you. Take an honest look at all your income and expenses throughout the month. I know this is hard. It changes every month. It's hard to get a handle on, especially I got 4 kids. You never know what's going to come and slap you with what sports pictures or cleats or whatever you're paying. You can never really budget for it, but look back at the last 12 months, figure out what you spent. I actually, if you're able to pay off your credit card every month, I like to actually put stuff on the credit card. That way you got a running total of what you did last year. You can see kind of where the money went. It kind of helps to look backward, figure yourself out, but I'm all for using cash too. We try to use cash for other stuff too, after we get the budget part figured out. I think that works great. So anyway, income minus expenses equals your cash flow. Cash flow will vary a little from month to month, like I said, but cash flow is the lifeblood of Velocity Banking. So you got to find your debt tool, okay? Home equity line of credit is far and away the best tool to use. You can use a personal line of credit. These are usually higher interest rates, can be a little harder to get, but totally fine, and this process will still work. And you can actually do this with a credit card if you have the behavior and the discipline to do it. All right, the credit card is the last resort. If you can find a credit card, for get a year and a half at 0%, go for it. That's free money. All right, load that thing up and pay some of your other debts off. Load it up on there. Pay your minimum payment, however you want to do it. But yeah, you can get into the system with doing that. Really increase your cash flow. But again, be careful, because you have all this extra cash flow. At some point, that year and a half is going to be up, and they're going to start charging interest, and then it's going to start hurting. So it can be done with a credit card, but that's last choice for me. All right, it's a tool. Compare it to a shovel, right? You can use a shovel to cultivate a beautiful garden. You can also smack somebody over the head and kill somebody with it. Okay, it's a tool like anything else. If you can't use it right, don't use it. All right, know yourself. I keep harping on this. You have to be disciplined. This is a great tool. It works so good. It's going to get you out of debt and create all this cash. But know yourself. If you don't have the discipline to do it, don't do it. It'll just get worse for you. All right, debt tool must-haves. It has to be a revolving line of credit, not a home equity loan. Not a loan. The bank, when you go in and ask for a home equity line of credit, they'll say, well, yeah, we have those, but interest rates are 10%, and you could get a home equity loan for 6%. Isn't that better? 6 is lower than 10. You want that, right? No. You need a revolving line of credit. Do not get a home equity loan. All that does is lock you back in for an extended period of time at those rates, and it's high interest up front. That's why they want to sell it to you. High interest rate up front, or high interest payments up front, and as you slowly pay the principal down, you're just a slave. They're keeping you a slave to the bank. So don't get the home equity loan. You need a home equity line of credit. Must be able to make multiple principal payments each month. I've heard some restrictions on that. The one I got, every time I get a paycheck, I just transfer it into my home equity line of credit, and life is good. So, must have check writing capabilities. I have actual paper checks that come with it. I've got a routing number. I've got an account number. So any place that you need to do an ACH payment out of, I give them that, and it goes right onto my HELOC. Interest only payment period for at least 5 years. I've got mine is 10 years. The more the better. I've actually heard of one place that's doing a first lien HELOC, for 30 years. Excuse me. So the longer the better with that. Online banking access is, like I said, very convenient. I don't know of anyone who doesn't have that anymore, so shouldn't be a problem. Debt acceleration, make multiple principal payments to reduce the balance. The lower the balance, the less interest you pay. So we kind of went through that in our example. I hope I'm not going too fast here, but trying to keep it moving. How it works. You got to know your budget and your cash flow. The more cash flow, the faster this works. So list out all your debts, kind of like we had on that first sheet that you can get off the website. Amount owed, minimum payment amount, and your interest rate. Use the debt tool then to pay one or multiple debts off in full, kind of like we just did in that example. And then when you do that, it'll eliminate your payments that you were making on that, adding that to your cash flow, just speeding this whole process up even faster. All right. And that is all I've got in a nutshell. Tried to go through the example and kind of explain it all. Please let me know what kind of questions you've got in the comments. Trying to help you guys. Once I figured this out, the light bulb just went off, and my life has not been the same since. So figured out I can maybe help some other people out. So hopefully this helps. And like I said, let me know in the comments how I can help you. And happy smashing that debt.